September 5, 1929. The grand ballroom of Babson College buzzed with confidence. 800 businessmen in tailored suits sipped champagne and nodded along to speeches about permanent prosperity. The Dow Jones had climbed to 381 points, nearly quadruple what it had been 5 years earlier. Factory workers were buying stocks on 10% down payments. Bank clerks were borrowing 90% to own shares. Everyone was getting rich. Then a balding statistician named Roger Babson walked to the podium. His voice was steady, his data was precise, and his 9 words would make him the most hated man on Wall Street. Sooner or later a crash is coming, and it may be terrific. The audience laughed. Newspapers mocked him the next morning. Irving Fisher, Yale professor, celebrated economist, advisor to presidents, dismissed Babson publicly, declaring that stock prices had reached a permanently high plateau. The market barely flinched. A 3% dip they called the Babson break, then right back to rising. 47 days later, on October 29, 1929, the market collapsed. 12% in a single day. 89% by 1932. Irving Fisher lost everything: his fortune, his home, his reputation. He died in poverty, still trying to explain how he'd been wrong. Roger Babson made a fortune. He founded a college that still teaches his methods today. But there was a problem. What Babson discovered wasn't luck. It wasn't intuition. It was a pattern, a 5-stage sequence of economic conditions that appears before every major financial collapse. He documented it in 1929. It reappeared in 1987, again in 2000, again in 2008, and right now, in early 2026. All 5 stages are either active or imminent. Wall Street knows about this pattern. Central banks know about it. The people who manage money for billionaires definitely know about it. But if you've never heard of it, there's a reason. Because when regular people understand what to look for, they pull their money out before the crash instead of after. The question is not whether you believe this. The question is, what will you do when the pattern completes itself? To understand how economic collapses work, we must first understand what they are not. They are not random. They are not acts of God. They are not caused by a single villain making a single bad decision. Economic collapses are systemic failures, the result of specific measurable conditions that build over years. Credit expands beyond what the real economy can support. Risk concentrates in fewer and fewer assets. Institutions that should act as circuit breakers instead amplify the danger. Liquidity, the oxygen that keeps markets functioning, quietly drains away. And then a trigger event, often small, reveals that the entire structure was built on borrowed time and borrowed money. The players in this story are not heroes or villains. They are rational actors responding to incentives. Roger Babson was not a prophet. He was a statistician who tracked credit levels, market concentration, institutional behavior, liquidity conditions, and what he called trigger vulnerabilities. 5 factors, 5 stages. What was at stake in 1929? Not just stock portfolios. By the time the Great Depression ended, unemployment would reach 25%. Banks would fail by the thousands. And an entire generation would lose faith in the economic system. What's at stake now in 2026? The same forces are gathering. The same imbalances are building. The same warnings are being ignored. Because when the history books are written about what happens next, there will be 2 groups of people: those who saw the pattern and those who didn't. Stage 1 is what Babson called the credit explosion. In the summer of 1927, something extraordinary began happening in American finance. Ordinary citizens, factory workers, shop clerks, school teachers, started borrowing money to buy stocks, not with their savings, with credit. Brokers offered them a deal that seemed too good to refuse. Put down $10, borrow $90, and control $100 worth of shares. The buying pushed prices higher. Rising prices made people feel wealthy. Feeling wealthy made them borrow more. It was a feedback loop that felt like prosperity. But there was a problem. By the spring of 1929, total margin debt in the United States equaled the entire federal budget. 3% of the nation's GDP was borrowed money sloshing around in the stock market. People weren't investing in businesses. They were speculating on price movements using leverage they couldn't afford to repay. The agricultural sector was already collapsing. Overproduction, falling prices, farmers drowning in debt. Consumer goods manufacturers had unsold inventory piling up because wages were too low to sustain purchasing power. Factory owners were cutting production and firing workers. But none of that mattered to investors. They kept buying shares in companies where output was declining and unemployment was rising. Why? Because prices were going up, and as long as prices went up, you could borrow more and buy more and sell at a profit. Roger Babson watched this and saw a trap being set. The trap was simple. When credit expands faster than the economy can absorb it, the system becomes dependent on continuous borrowing. The moment borrowing stops, the entire structure collapses. He tried to warn them. Wise are those investors who now get out of debt and reap their sales, he said on September 5th. Pay up your loans and avoid margin speculation. They ignored him. And now, in 2026, we sit inside a credit trap that makes 1929 look quaint. Official margin debt sits around $750 billion, but that number is a lie. It only captures brokerage margin accounts. Add in securities-based lending, where wealthy investors borrow against their portfolios, and you add another $800 billion. Add in the leverage embedded in options markets, where a small amount of money can control massive positions, and you add trillions more in notional exposure. Add in corporate debt, which has exploded to over $10 trillion, much of it used not to build businesses, but to buy back stock and inflate share prices. Add in government debt, which has crossed $34 trillion and requires interest payments larger than the defense budget. As a percentage of GDP, total debt in the American economy is now higher than it was in 1929, higher than 2008, higher than any point in recorded history. The credit system isn't expanding, it's infected. And the contagion is spreading through every layer of the financial structure. Stage 1 isn't just flashing red, it's on fire. Stage 2 is the concentration trap. Here's what they don't teach you in finance class. Crashes don't just happen because prices are high. They happen because risk is concentrated. In 1929, a handful of glamour stocks dominated the market. When they cracked, the whole market cracked with them. In 2000, it was the dot-coms, Cisco, Intel, Microsoft, a handful of tech names. The NASDAQ was essentially a bet on 10 companies. When those 10 rolled over, trillions in wealth vanished. In 2008, concentration was hidden in the banking sector. 5 banks held the majority of derivatives exposure. When Lehman Brothers went down, it nearly took the entire global financial system with it. Instead of learning from these disasters, we've made concentration worse. But here's what nobody talks about. As of early 2026, the top 7 stocks in the S&P 500 account for over 30% of the entire index. At certain points, it's been closer to 35%. Apple, Microsoft, Google, Amazon, Nvidia, Meta, Tesla. 7 companies, 35% of the value. Think about what that means. When you buy an S&P 500 index fund, which is what sits in most 401ks and retirement accounts, you're not buying 500 companies. You're making a massive leveraged bet on 7. If those 7 stocks drop 50%, your diversified index fund drops 15 to 20%, even if every other stock stays flat. And here's the thing about those 7 stocks. They're all trading at valuations that require perfection. Not good earnings, perfect earnings. Any disappointment, any slowdown, any crack in the narrative, and the selling will feed on itself. Passive investing has made this worse, but there's a mechanism at work that most investors don't understand. Every dollar that flows into an index fund automatically buys more of the biggest stocks, pushing their prices higher, increasing their weighting, which means the next dollar buys even more. It's a momentum machine that works beautifully on the way up. On the way down, it reverses. Every dollar that flows out sells the biggest positions first. Forced selling creates more selling. Price declines trigger more redemptions. The feedback loop that felt like genius on the way up becomes catastrophe on the way down. This is stage 2, the concentration trap. And we're deeper in it than we've ever been. Stage 3 is what Babson called the smart money exit. This is the stage that reveals how the game actually works. In the summer of 1929, while newspapers were celebrating the new era of permanent prosperity, something quiet was happening. The Morgans and the Rockefellers started liquidating positions. Bernard Baruch, one of the richest men in America, was almost entirely in cash by September. Joseph Kennedy, who would later become ambassador to Britain, sold everything after his famous shoe-shine boy conversation. But the real reason Kennedy sold? He had connections to people who knew what was happening inside the banks. He knew that credit conditions were tightening. He knew that margin calls were starting to ripple through the system. He knew that when the selling began, there would be no buyers on the other side. Regular Americans kept buying. They were the exit liquidity for the smart money. In 2007, the pattern repeated. Hedge funds started shorting subprime mortgages a full year before the crash. Goldman Sachs famously bet against the same securities they were selling to clients. Executives at Countrywide and other mortgage lenders were dumping their personal stock while telling investors everything was fine. Regular Americans kept buying houses and bank stocks. They were the exit liquidity. But here's what's happening right now, in January 2026. Corporate insider selling has reached levels we haven't seen in decades. CEOs, CFOs, board members, the people who actually know what's happening inside these companies, are selling their stock at a historic pace. The ratio of insider selling to insider buying is at extreme levels. For every insider buying shares of their own company, multiple insiders are selling. However, the reality was this. While insiders sold, retail investors, regular people, have been pouring money into the market. Robinhood accounts, 401k contributions, passive index flows. Record amounts. The smart money is selling. The regular people are buying. This is not a coincidence. This is the pattern. This is how it works every single time. Stage 4 is the liquidity illusion. In 1928 and 1929, the Federal Reserve raised interest rates and tightened monetary conditions. They were trying to cool off speculation. What they actually did was drain the liquidity that was supporting asset prices. For a while, nothing happened. The market even kept rising. People thought the Fed's tightening didn't matter. But there was a problem. Then October came. When selling started, there was nobody on the other side. The bids just vanished. Stocks didn't decline. They went into freefall because there was literally no liquidity. In 2007 and 2008, the same thing happened. The Fed had been raising rates, credit conditions were tightening, but the stock market stayed high. Housing prices stayed high. Everything seemed fine. Then Bear Stearns collapsed, then Lehman, and suddenly everyone realized the liquidity was gone. Now look at where we stand in 2026. The Federal Reserve sits at its desk with interest rates that have risen at the fastest pace in 40 years. They've gone from 0 to over 5% in less than 2 years. They've been running quantitative tightening, pulling hundreds of billions of dollars out of the financial system. And yet, the stock market trades near all-time highs. People think this means the tightening doesn't matter. They think we've achieved a soft landing. But the cracks are already showing. In March 2023, 3 major banks failed in a single week: Silicon Valley Bank, Signature Bank, First Republic. These weren't small institutions. They failed because of a liquidity crisis caused by rising rates. The Fed had to step in with emergency lending programs. They essentially printed money to backstop the banking system while claiming they weren't doing a bailout. Those emergency programs are temporary patches. They don't fix the underlying problem. They just delay it. The Treasury market, the foundation of the entire global financial system, shows signs of stress that most investors ignore. Bid-ask spreads widening, flash crashes in overnight funding markets. Repo market disruptions that require Fed intervention. Liquidity is draining away. Again, just like 1929, just like 2008. And that brings us to Stage 5, the trigger event. The tragic irony is that the trigger is almost never the thing people expect. In 1929, it wasn't the economy. It was a margin call cascade that nobody saw coming. In 2008, it wasn't housing. It was the realization that derivatives had spread risk everywhere and nobody knew who was holding the bag. The trigger doesn't have to be big. It just has to reveal that the system is fragile. A bank fails, a corporate bankruptcy, a foreign debt crisis, a cyber attack on payment systems, a geopolitical shock. It doesn't matter what lights the match. What matters is that the entire structure is soaked in gasoline. What happened after October 1929? Within 2 weeks, the market had lost 30% of its value. Within 3 years, it had lost 89%. Banks failed by the thousands. Unemployment reached 25%. Men and women lost their life savings. An entire generation's economic security vanished. But the collapse didn't stop at Wall Street. The psychological effects reverberated across the nation. Businesses couldn't secure capital for new projects. Workers faced job insecurity. Consumer spending collapsed. The credit contraction turned a stock market crash into the Great Depression. The long-term consequences stretched for decades. Social Security was created because people no longer trusted markets to provide for retirement. Banking regulations were written because the system had proven itself incapable of self-regulation. An entire political and economic order was reshaped. And now, in 2026, we stand at a similar threshold. The conditions that preceded 1929 are not just similar, they are more extreme. Debt is higher, concentration is tighter, leverage is deeper, liquidity is thinner. This teaches us something profound. Economic collapses are not anomalies. They are features of systems that prioritize short-term gains over long-term stability. They happen when credit grows faster than productive capacity, when risk concentrates instead of dispersing, when institutions that should act as stabilizers instead amplify instability. The modern parallels are everywhere, and they're accelerating. Student debt has surpassed $1.7 trillion. Auto loans are extended to borrowers with subprime credit. Corporate balance sheets are leveraged to fund stock buybacks instead of innovation. But there's more that nobody's talking about. Private equity firms have loaded companies with debt approaching $2 trillion not to build businesses, but to extract wealth through leveraged buyouts. Banks have underwritten $65 billion in leveraged buyout debt just for 2026 alone, betting that markets will remain calm enough to offload that risk to investors. These are the same financial engineering tactics that imploded in 2008, repackaged with different names. Cryptocurrency markets, which didn't exist in 2008, now represent over $3 trillion in largely unregulated speculation. Bitcoin trades above $90,000, while the total digital asset market cap swings by hundreds of billions in single weeks. This isn't investment, it's leveraged gambling on a global scale, and artificial intelligence stocks have become the new dot-com bubble. Companies with minimal revenue trade at valuations requiring perfect execution for decades. NVIDIA crossed $5 trillion in market cap. Palantir trades at 120 times sales, a valuation that can't be justified by any historical precedent. Microsoft, Alphabet, Amazon, and Meta have pledged $440 billion in combined capital expenditures for AI infrastructure over the next year, a 34% increase. History suggests these valuations end badly. When the dot-com bubble burst in 2000, even great companies lost 80–90% of their value. The floor may be higher this time. But the mechanics are identical. The housing market in major cities has become detached from local incomes. 7 technology companies control more than a third of the stock market's value. And the people who manage this system, central bankers, regulators, politicians, insist that this time is different. It's not. Roger Babson understood something in 1929 that most people still don't understand today. Markets are not machines that produce wealth. They are systems for allocating capital. And when capital allocation becomes disconnected from economic reality, the system corrects itself. Violently. The question is not whether a correction will come. The question is whether you'll be positioned for it or destroyed by it. This does not mean the market will crash tomorrow. Timing is impossible. Markets can stay irrational longer than you can stay solvent. Anyone who tells you they know exactly when the crash is coming is lying. What I am telling you is this. The conditions that preceded every major crash in the last 100 years are present right now. All 5 stages are either active or imminent. This is not normal. This is not a drill. The difference between Roger Babson and Irving Fisher wasn't intelligence. Fisher was probably smarter. The difference was that Babson paid attention to the signals. He respected the pattern. He positioned himself for what was coming instead of what he wished would happen. You have the same choice right now. You can look at this data and decide it doesn't apply to you. Markets always recover eventually, right? This time could be different. Or you can ask yourself uncomfortable questions. How much of your wealth is in the stock market right now? How much is concentrated in mega-cap tech stocks? How much of your financial security depends on prices staying where they are or going higher? If the market dropped 50% over the next 18 months, which is what happened in 2008, would you be okay? Nobody warned them in 1929. Nobody warned them in 2008. Nobody's going to warn you now. The warning is the pattern itself, and now you know it. What you do next is up to you. This is the hidden history. Subscribe now because when the next chapter is written, you'll want to be among the few who saw it coming.